Please like, share, and subscribe. Wishing you happiness and good luck every day.
So you want to make your money work for you, right? I mean, really work for you. Not just sit in an account somewhere, but actually get up every morning and bring home a paycheck. Well, you are in exactly the right place. Today, we're going to pull back the curtain on one of the most powerful, time-tested strategies for building wealth, dividend investing. We're going to break down what it is, how it works, and exactly how you can get started.
But first, let me start with a question, something that might be nagging at you in the back of your mind. You work hard, you save your money, you put it aside, but are you actually moving forward? Because there's this silent, invisible force working against you every single day, and it's called inflation.
Here's how it works in a nutshell. Let's say you invest and get a 7% return for the year. Hey, that sounds pretty good, right? But if the cost of everything, your groceries, your gas, everything, goes up by 3%, your real gain, the actual extra spending power you have, is only 4%. Inflation is this silent money eater, and if you're not careful, it will devour your savings. So, how do you fight back? Well, one of the most potent weapons in your arsenal is dividends. And get this, for almost a century, nearly 40% of the total return from the S&P 500, that's the 500 biggest companies in the US, didn't come from stock prices shooting to the moon. Nope, it came from companies simply paying out cash dividends to their shareholders. This isn't just some little cherry on top, it's a massive fundamental engine of wealth creation. And that's exactly why we've got to look at dividends in a whole new light. They're not just a little extra cash that shows up in your account. They are an active, powerful tool, your secret weapon to protect your money from that silent inflation beast and, more importantly, to actually make it grow. So what exactly is a dividend when you get right down to it? It's actually beautifully simple. When you own a share of a company, you're not just a customer, you're a part owner. And when that company turns a profit, it has a choice. It can reinvest that money, or it can share a piece of the profits directly with its owners, with you. It's a tangible cash reward for being an owner, and it's almost always a sign of a stable, healthy business. All right, so if you're on board with the why, the next obvious question is, where? Where do we find these dividend-paying companies? Let's pull out the map and start looking at the territory. Now, here's the crucial thing to understand. Not all companies are created equal when it comes to paying dividends. You've got your younger, high-flying tech companies that pour every single penny back into growing as fast as humanly possible. But the classic hunting grounds for dividend investors are the big, established companies with steady, predictable businesses that churn out cash year after year. Let's take utilities, for example. Think about it. You and I, we're always going to need to keep the lights on and the water running, right? It doesn't matter if the economy's booming or in a slump. These companies provide absolute necessities, which means they have very consistent revenue, and that consistency is what allows them to be such reliable dividend payers over time. It's the same deal with consumer staples. Just picture your last trip to the grocery store. All those brands of food, drinks, soap, toothpaste, those are things people buy over and over again, in good times and in bad. That predictability, that brand loyalty, is an absolute goldmine for an investor looking for a steady dividend check. And you see the same kind of thing in other sectors, like energy and telecoms. Think about the massive cash flow generated from oil and gas production, or the money that comes in every single month from millions of people paying their cell phone bills. The business model itself is just built to generate a steady stream of cash that can be passed on to investors. Okay, so we've got our map. We know where the good hunting grounds are, but that's not enough. Just because a company's in the right neighborhood doesn't automatically make it a great investment. Now we've got to learn how to look under the hood. It's time to get our basic tools out and learn how to analyze a company's health. The secret here is learning to look at a company's fundamentals. And I want you to think of fundamentals like a company's vital signs, kind of like when you go for a physical. They tell you the real story of what's going on inside a business, and you find them in 3 main reports that every public company has to release. First up is the balance sheet. Now, don't let the name scare you off. It's actually really simple. It's just a snapshot in time. On one side, you have assets. That's all the stuff the company owns, like cash, buildings, and equipment. On the other side, you have liabilities. That's what the company owes, like debt. For us, we want to see a company where the owns column is a whole lot bigger than the owes column. Simple as that. Next up is the cash flow statement. And honestly, this one's my favorite. I love this analogy. It's basically the company's checkbook. It's not about complicated accounting, it's about the cold, hard cash. It shows you exactly where money came in from and where money went out. It answers the most important question: is this business actually bringing in more cash than it's spending? And listen, this is a super important warning. A company can fudge its numbers to look profitable on paper, but still be bleeding cash. The cash flow statement doesn't lie. It tells you the truth. Because at the end of the day, dividends are paid with real cash, not accounting profits. If the cash isn't flowing in, that dividend you're counting on is in danger. You've heard it before, and it's true. Cash flow is king. Now that we've got the tools to look at a business, it's time to kind of turn that lens around and look at ourselves. Because I'll tell you what, the most brilliant financial plan on earth is completely worthless if it doesn't match your personality. The best investing is always, always personal. So let me ask you, straight up, how much risk can you really handle? You know, the best way to figure this out is incredibly simple. Does it keep you up at night? If you're lying in bed, staring at the ceiling, worried because the market had a rough day, well, you've probably taken on more risk than you're truly comfortable with. You know, there's no such thing as a free lunch, especially in investing. The link between risk and reward is a fundamental law. If you're chasing those really high returns, you have to accept the possibility of bigger losses. On the other hand, if you want more safety, you have to be okay with smaller potential gains. Finding your sweet spot on this scale is the absolute key to building a plan you can stick with for the long haul. And hey, a quick but really important side note here. When we talk about a conservative investor in the financial world, it just means someone who is careful. It means someone whose top priority is protecting their money, rather than shooting for the moon. It has absolutely nothing to do with politics. It's just a word for being cautious. All right, we have covered a lot of ground. We've talked about the why, the where, the how, and the who, which is you. So now let's get down to brass tacks. Let's talk about the practical, real-world steps you can take to actually get this journey started. Broadly speaking, you've basically got three main roads you can go down. First, you can go the totally hands-on route and pick individual stocks yourself. Or if you want something more diversified and a little more hands-off, you can look at mutual funds or ETFs, which are basically just big baskets that hold lots of different stocks all at once. So let's break down the two most popular choices for folks just starting out. Mutual funds are fantastic for that set-it-and-forget-it approach. You can set up automatic investments every month and just let it run. ETFs, on the other hand, are a bit different. They trade all day long, just like a regular stock. They also tend to have lower fees and can be a bit more flexible. Look, neither one is better. It's all about picking the right tool for your own personal style. And one last tip for you, especially if you're feeling a little nervous about jumping in all by yourself, you might want to think about joining an investment club. It is a fantastic way to learn with other people, to share research, and to just bounce ideas off each other and build your confidence before you put your own hard-earned money on the line. So, there you have it. We started with the quiet threat of inflation and ended up with a real, tangible plan for fighting back and building wealth. When you think about it, your financial plan is really just a story that you get to write, one chapter at a time. So the only question left is, what are you going to write in the next chapter?
All right, let's get right into it. Today, we're going to pull back the curtain on dividend stocks. You know, they're this really powerful tool for building wealth that honestly, a lot of people just kind of overlook. We're going to cover all the essentials you need to get started, so let's dive in.
So, this is the big question, right? It's the one that kind of flips the script on what we think we know about investing. We're all taught that the name of the game is to buy low and sell high. Simple enough. But what if? What if there was another way? A way to actually get paid, to realize profits, while you still own your shares? That's the whole idea we're going to unpack today.
Okay, first things first. Before we go any further, we have to ask the most basic question. What exactly is a dividend stock? Let's build a really solid foundation here. And there's your answer. A dividend is just a company sharing its success directly with you, the shareholder. I mean, think about it. You own a piece of the company, so it's like getting your slice of the pie. When that company makes money, it has a choice, and one of those choices is to give a chunk of those profits right back to its owners. And that cash payment, that's your dividend.
You know, this slide really gets to the core of a company's whole philosophy. On one side, you've got the pro-growth mindset. These companies take every single penny of profit and plow it right back into the business to get bigger, faster. But on the other side, you have the pro-profit sharing view, which says, hey, let's reward the people who own this company, the shareholders, right now. Dividend stocks, well, they live firmly in that second camp.
All right, so now we know what they are. Let's start mapping out the terrain. Because look, like any investment journey, there are going to be some absolutely beautiful views and, yeah, some potential hazards along the way. Understanding both sides of that coin is absolutely critical before you take a single step forward.
So from a 30,000-foot view, it kind of looks like this. The upside, I mean, it's pretty compelling, right? You've got the potential for a stream of passive income, the kind of stability that often comes with these bigger, more mature companies, and, of course, the chance for the stock's price to go up. But we have to be realists here. The downside is just as real. The stock price can absolutely drop, and, this is a big one, a company can decide to cut its dividend payments anytime.
So let's zoom in on that upside for a minute, because this is why people get excited. The passive income part is huge. It's like your investment is sending you a paycheck just for owning it. But you also get two ways to win. You get the dividend itself, and you can get any increase in the stock's price. But the key here, the real magic, is that you can collect those profits without selling a single share. And you can even use that dividend cash to buy more shares. That creates this incredible compounding effect over time.
Now, on the flip side, we have to be really vigilant about the risks. Just because a stock pays a dividend doesn't make it bulletproof. The share price can still fall, just like any other stock. But the most crucial point, and you really need to hear this, is that dividends are never, ever guaranteed. It's not like a bond payment where a company is legally on the hook. Nope, if times get tough for a company, that dividend payment might be the very first thing they decide to cut. Okay, we've mapped the terrain. We've seen the good and the bad. Now, it's time to turn inward a little bit and find your personal compass. Because understanding who you are as an investor and what your tolerance for risk is maybe the most important part of this whole thing.
So let's have an honest chat with ourselves. Are you the kind of person who loves the roller coaster? The thrill seeker who's chasing those high-risk, high-reward stocks? Or are you more of a slow and steady navigator, someone who prefers a much calmer journey, who's willing to trade some of those explosive potential gains for stability and, frankly, a good night's sleep? Knowing where you fall on that spectrum, that's step one.
And finding your answer really comes down to these four things. First, your age. It's a big one. If you're younger, you just have more time to recover from any losses. Second, your wealth. And this is non-negotiable. Never, ever invest money you can't afford to lose. Third is just your personality. Do market swings make your stomach turn? If so, you know what to do. And finally, what are your goals? Are you swinging for the fences, trying to get rich quick, or are you playing the long game, building wealth over decades?
So with that personal profile in mind, let's look at the main ways people invest. You've got value investing, which is kind of like being a treasure hunter at a garage sale. Then you have growth investing, which is all about betting on the next big thing. And then there's our focus today, income investing. And as you can see, the goal here is totally different. It's all about generating a steady, reliable stream of cash, focusing on things like a high yield and a long, solid history of making those payments. Okay, you've got your compass, you know your direction. Now it's time to pack your toolkit. Because if you're going to navigate the market successfully, you need the right instruments, the right tools to really analyze a company and decide if it's a worthy investment for you.
First up in the toolkit is dividend yield. It's just a simple percentage, but it tells you a lot. It answers the question, for every dollar I put in, how much am I getting back in dividends each year? So a 5% yield is simple. You get 5 cents back for every dollar you invest. It's a really quick way to see what the dividend payout looks like.
Next up is the PE ratio. Now, this is your valuation tool. It basically answers the question, is this stock cheap or expensive compared to what it's actually earning? So if a company's stock is trading at $50 a share and it earns $5 per share in profit, its PE ratio is 10. You're paying $10 for every $1 of its profit. It's a great way to compare companies in the same industry.
And our third key tool is the payout ratio. And this brings us right back to that philosophy question we talked about at the beginning. This number tells you exactly what percentage of a company's profits are being paid out to shareholders as dividends. Are they paying out just 20% and reinvesting the other 80%? Or is it the other way around? This tells you a ton about the company's priorities and, more importantly, how sustainable that dividend payment really is.
Now listen up, because this is probably the most important thing I'll say about these tools. You cannot, I repeat, cannot just look at one of these numbers by itself. It's like trying to build a puzzle with only one piece. A super high dividend yield might look amazing, right? But if the payout ratio is over 100%, that means the company is paying out more money than it's even making. That's a massive red flag. These numbers only work when you use them together to paint a complete picture of a company's health.
Okay, for our final section, let's bring all of this together. You've got the concepts, you've got the tools in your toolkit. Now, let's talk about the big picture. Let's talk strategy.
One really famous strategy you'll hear about is the dogs of the Dow. It's a pretty simple idea, actually. You look at the Dow Jones, 30 of the biggest, most established blue-chip companies, and you pick the ones with the highest dividend yields. The theory is that a high yield often means the stock price has taken a temporary hit, so these dogs might be undervalued and poised to bounce back, giving you both a nice income stream and potential for price growth. And here's another great approach, this one from Geraldine Weiss, who is a real pioneer in dividend investing. Her strategy is all about value. You find high-quality, blue-chip companies, but you only pull the trigger and buy when their dividend yield is near its all-time high. Why? Because again, a historically high yield usually means the stock price is historically low. You're basically buying quality, but you're waiting until it goes on sale. Look, no matter what specific strategy you choose, please keep these 4 core principles in mind. 1. Never stop learning. Knowledge is your best defense. 2. Consider dollar-cost averaging, investing a set amount regularly to smooth out the bumps. 3. Diversify. You've heard it a million times, but don't put all your eggs in one basket. And 4. Make sure your strategy actually fits your timeline and your goals.
We have covered a lot of ground today. You get what dividends are, you understand the rewards and the risks, you know how to figure out your own investor profile, and you've got the essential tools for analysis. You literally have the map and you have the compass. The only question left is, where is your investment journey going to take you?
Hey there, and welcome. Do you ever get that feeling that you might be missing a piece of the puzzle with your investments? Well, today we're going to pull back the curtain on a seriously powerful but often overlooked engine of stock market profits: dividends. And I promise, by the end of this, you'll be looking at your portfolio in a whole new light. So, let me ask you something. When you think about making money from stocks, what's the first thing that pops into your head? For most people, it's all about that classic mantra, buy low, sell high, right? But what if I told you that's only half the story? What if there's another, more consistent way that wealth has been built in the market for literally decades? Get this. Historically, almost 40% of the stock market's total return, that's all the profit, hasn't come from soaring stock prices. Nope, it's come directly from dividends. Those regular cash payments that companies send out to their shareholders. Just let that sink in for a second. If you're ignoring dividends, you're potentially ignoring almost half of the market's long-term growth. It's a huge deal.
Okay, so before we dive headfirst into individual dividend stocks, we got to take a step back and look at the big picture. Because, let's face it, the health of the overall market has a massive impact on whether a company can even afford to pay a dividend. And the best way to get a quick checkup on the market's health? That's by looking at the major indexes.
I really love this analogy from our source material. It just clicks. An index really is like a barometer for the market. You see a barometer rising, you know good weather's on the way. Same thing here. When business is booming and the economy is healthy, the index tends to go up. And you know what that means? Companies are profitable, and they're much more likely to be sending those dividend checks your way. So let's talk about the 2 big ones you always hear about on the news. First, you've got the Dow Jones. It's famous, but you know what? It only tracks 30 giant US companies. And it's what we call price-weighted, which is kind of weird. It means a stock with a high price, say $300, has more influence than a stock with a low price, even if that second company is actually way bigger. The S&P 500, on the other hand, gives you a much better snapshot of the whole market. It tracks 500 companies, and it's market cap weighted. All that means is the bigger the company's total value, the more sway it has. So, if you really want to know how the US market is doing, the S&P 500 is the one to watch.
All right, we've looked at the big picture. Now let's zoom in a little. Let's talk about the actual building blocks of the market. Stocks. When you buy a stock, you're buying a tiny slice of a company. But what a lot of people don't realize is that there are actually 2 main flavors of stock: common and preferred. And they are very, very different.
So when you or I or anyone else says they own stock, 99% of the time this is what they're talking about: common stock. It's your all-access pass. It means you actually get a vote on big company decisions, and more importantly, you get a piece of the profits. If the company crushes it, you can win big in 2 ways. The stock price goes up, and you get that sweet, sweet stream of dividend payments. And here's where the strategy comes in. With common stock, your dividends are variable. If the company has a great year, they might give you a raise. But if times get tough, they could also cut that dividend. Now, preferred stock is different. It's more predictable. You get a fixed, steady dividend payment, kind of like a bond. The trade-off: You get no voting rights, and you typically don't see the same explosive price growth. It really boils down to what you're looking for: higher growth potential or more stability. Now, here's the tough part about common stock. It's the risk. If a company goes completely bust, common shareholders are at the absolute back of the line to get paid. The banks, the bondholders, even the preferred shareholders, they all get their money first. Most of the time, the common stockholders get, well, nothing. It's a sobering reminder that with that high potential for reward comes some pretty serious risk.
Okay, you ready for this? Because we're about to get to the absolute heart of the matter. We're going to talk about the real secret sauce to long-term investing success. And it all comes back to those little dividend payments we've been talking about. This is the concept that separates the casual investor from the really savvy one.
I want you to think about it like this. Imagine you own a rental property. At the end of the year, how do you figure out how well you did? You don't just look at how much the house's value went up, right? Of course not. You've got to add in all the rent checks you collected. Well, stocks are exactly the same. The true measure of performance isn't just the change in stock price. It's the total return. That's the price change plus all the dividends you got paid along the way.
And when you look at the actual numbers, it's pretty mind-blowing. Let's take the S&P 500. Going way back to 1926, the average annual return has been fantastic. But look at where it came from. The price appreciation, the stock going up, was about 6.25%. But the dividends, they kicked in almost another 4%. That's a huge slice of the pie. It's like getting a bonus every single year just for being an owner.
And it's not just a fluke. Look at the Dow Jones. Over the last couple of decades, dividends have been responsible for a whopping 45% of the index's total profits. Almost half. It just goes to show you if you're only focused on stock prices going up and down, you are leaving a massive amount of money on the table. And you know when dividends are an absolute lifesaver? When the market gets ugly. Think about that lost decade for investors. From the dot-com bust in '99 through the financial crisis in '08. It was brutal. If you just held the Dow stocks, their prices actually fell over that period. You would have lost money. But if you were collecting and reinvesting those dividends, you would have turned that loss into a solid 18% profit. Dividends are like a financial life raft in a stormy sea. So I think we've made the case. Dividends are a really big deal. But that leads to the next question, right? How can you tell if a particular dividend stock is a good deal? How do you compare one company to another, or even to just sticking your money in a savings account? Well, there is a simple, elegant little number that does all the heavy lifting for you. It's called the dividend yield. The math is super simple. You just take the total dividends the company pays out for the year and you divide it by the current stock price. That's it. What you get is a percentage, the dividend yield. You can think of it like the interest rate you're earning on your money. The higher the yield, the more cash you're getting back for every dollar you invest. It's all about getting the most bang for your buck.
And this is why that number is so magical. Let's do a quick example. Say stock A costs $20 a share and pays a $1 dividend. Stock B costs $200 a share and pays a $5 dividend. Now, which one's the better dividend investment? Your gut might say stock B because $5 is more than $1. But let's run the numbers. That $20 stock has a 5% yield. The $200 stock, it only has a 2.5% yield. See? The cheaper stock is actually giving you double the return on your money. That's the power of yield.
Okay, let's get into the nitty-gritty details. You've done your homework, you found a great company with a solid yield, and you're ready to pull the trigger. But wait just a minute. Did you know that the exact day you buy that stock can make the difference between getting paid next month or not? It's true. You've got to understand the dividend calendar. The whole process kicks off with a public announcement, something just like this. A company comes out and says, "Hey everyone, we're paying a dividend." And then they give you a few very specific dates. These dates are your roadmap. They tell you exactly what needs to happen and when for that money to land in your account. But before we get to the timeline, there's one little quirk about the stock market you need to know. Buying a stock isn't instant. It's more like closing on a house. There's a trade date, that's the day you click buy, but then there's a settlement date, which is when the transaction officially goes through and you become the legal owner. And that little lag, it's absolutely critical when it comes to dividends. So here's how it all plays out. First, there's the declaration date, when the company announces the dividend. Next, and this is the most important one, is the ex-dividend date. Think of this as the cutoff. You must own the stock before this date to get the payout. Then comes the date of record. That's when the company looks at its books and sees who officially owns the stock. And finally, the best day of all, the payment date. That's when the cash actually hits your account. If you take away just one thing from this whole section, please let it be this. You have to own the stock before the ex-dividend date. That's the golden rule. It's not the record date, not the payment date. It's all about that X date. If you buy the stock on the ex-dividend date or any day after, you've missed the boat for that payment. You'll have to wait for the next one.
Now you might be thinking, aha, I'll just buy the stock the day before the X date, grab the dividend, and sell it the next morning for a quick profit. Nice try, but the market's already thought of that. On the ex-dividend date, the stock's price will almost always open lower by the exact amount of the dividend. Why? Because that cash is no longer in the company's bank account, it's on its way to shareholders like you. As they say, there's no free lunch on Wall Street.
So there you have it. Dividends aren't just some boring, optional extra. They're a core component of building wealth. They're a defense in bad times and an accelerator in good times. The real question is, now that you see this hidden power of payouts, how is it going to change the way you look at your own investments? What are you going to do with this knowledge to build a stronger financial future? Something to think about. Thanks for joining me.
Welcome back to The Explainer. All right, today we're going to talk about something really interesting, an investment tool that can literally pay you just for owning it. You know, think about this for a second. What if your stocks could actually pay you? Kind of like a salary. I mean, a steady stream of cash hitting your account, completely separate from whether the stock price goes up or down. It's a powerful idea, right? So let's get into it. Well, that's not just some fantasy. It is absolutely possible, and it's all thanks to something called a dividend. For a lot of really savvy investors, this isn't just some side strategy. It's the core of how they build wealth. So what exactly is a dividend-paying stock? Well, it's pretty simple, really. You own a share of a company, and when that company makes a profit, they decide to share a piece of it directly with you, their shareholder. We're talking about cold, hard cash that just shows up in your account, usually on a regular schedule. It's your reward for being an owner. All right, so now we're going to look at why this is such a big deal. The first thing you've got to understand is that with dividends, you get two different ways to win. Okay, so here's how it works. On one hand, you have price appreciation. That's what most people think about with stocks. You buy a share, and hopefully its value goes up over time. But with these stocks, you get a second punch. You also get the dividend payments, that direct cash return we talked about, and that happens no matter what the share price is doing. So let's put some numbers to this. Imagine your stock's price goes up by 4% in a year. Nice, but what if the company also pays a 3% dividend? Well, your total return isn't just 4%. It's 7%. You see, it's that combination, that 1-2 punch, that makes this so powerful. And it doesn't stop there. The benefits really start to stack up. First, you're building a steady stream of passive income. I mean, who doesn't want that? Second, you're getting cash profits without having to sell your shares. You can take some money off the table while still owning a piece of a great company. Dividends can also act as a cushion. If the market takes a tumble, that cash you're getting helps soften the blow. And finally, over the long haul, that consistent cash flow can be a way better hedge against inflation than just hoping the stock price goes up. It's a really well-rounded approach. Okay, so you've got this cash coming in from your dividends. The big question is, what do you do with it? And the answer to that question is where we get into what some people, myself included, think is the most powerful force in all of finance. We're talking about compounding. To really see this in action, let's imagine two investors. We'll call them Party Pete and Frugal Faye. Now, they both start out in the exact same position. They each invest $2,000 into the same stock, which gets them 100 shares. The company pays a $2 dividend per share, so at the end of the year, they each get a check for $200. Same starting line, same cash payout. But what they do with that money is where things get interesting. So Party Pete lives up to his name. He takes his $200 and, goes out for a great dinner. Nothing wrong with that. But Frugal Faye, she takes her $200 dividend and immediately reinvests it, buying 10 more shares of the stock. So after year one, she doesn't have 100 shares anymore. She has 110. Now check this out. The next year, when the company pays its dividend, Pete gets another $200 because he still has 100 shares. But Faye, she gets a dividend on her 110 shares, so she gets $220. She takes that money and buys another 11 shares. Now she's up to 121. You can see where this is going, right? By the end of year 3, the process repeats. Her dividend is now even bigger because she owns more shares, and she uses it to buy more shares. Her little investment snowball is starting to roll downhill, picking up speed. She's at 133 shares, while Pete's still sitting at 100. Okay, so let's fast forward 3 years and say they both decide to sell at the same price. Look at the difference here. Pete is still at 100 shares. Faye has 133. Pete collected $600 in dividends over that time, which he spent. Faye collected more, $662, because her share count was growing. But look at the total return. The difference is huge. Faye's simple, disciplined decision to reinvest her dividends just crushed Pete's return. I mean, look at that number, over 20% more profit. And what did she do that was so special? Nothing. She just let her money work for her. Her dividends bought more shares, which then earned their own dividends, which bought even more shares. That right there is the magic of compounding. It's an absolute game changer over the long run. Okay, that all sounds great, right? Almost too good to be true. And, well, we need to be realistic here. It's not all sunshine and rainbows. Like any investment, there is another side to this coin. There are real risks and downsides of dividend stocks that you absolutely have to understand. We've all heard this a million times, right? Past results are no guarantee of future performance. It's on every investment document. But with dividends, this is not just some legal boilerplate. It is a critical warning. A company could have a perfect track record of paying dividends for decades, but that is absolutely no guarantee that the check will arrive tomorrow.
So let's break down exactly what those pitfalls are. What are the specific things you need to be watching out for?
First, understand that many of these stable, dividend-paying companies aren't exciting growth stocks. Their price might not shoot to the moon like some tech startup. That's the trade-off. Second, and this is a big one, the share price can still go down. A 3% dividend doesn't feel so great if the stock price drops 20%. And here's the most critical point of all. A dividend is a promise, not a law. A company can slash it or even get rid of it completely anytime they want. And finally, you have to think about taxes. The way the government taxes dividends can change, and that can impact your overall return.
Okay, so given those risks, how do you protect yourself? How do you avoid the pitfalls? Well, the answer is you don't just buy any stock that pays a dividend. You have to learn how to spot a genuinely solid, healthy, mature company. I like to think about this like the life cycle of a person. You've got the infancy stage. This is your classic startup, high risk, but huge potential. They're burning through cash to grow, so no dividends here. Then comes childhood and teenage years. Growth is still the main goal. But then you get to adulthood. This is where growth slows down, but things become much more stable and predictable. The company is generating consistent profits. This is the sweet spot. This is where you find most of the reliable dividend pairs. They might be a bit boring, but boring can be beautiful when it comes to investing. So if we're looking for these adult companies, what are the green flags? What are the qualities you should be actively searching for? First, look for maturity. A long, proven track record is a good sign. Second, pay attention to management. A management team that chooses to pay a dividend is sending a signal of confidence. It shows fiscal discipline. Third, look at the industry. You often find the most stable dividend payers in essential industries. Utilities, consumer goods, energy, the stuff people need no matter what. And finally, you still want to see earnings growth. The profits have to be growing consistently to support not just paying, but hopefully increasing that dividend over time. All right, now let's flip that around. Just as important as knowing the green flags is knowing the red ones. What are the early warning signs that spell trouble? These are the things that should make you very, very nervous. Are sales or profits going down? Is the company taking on a mountain of debt? Is it actually losing cash instead of making it? If you see any of these, that's a warning. But the biggest red flag of them all is a dividend cut or suspension. That is the company's management screaming from the rooftops that they are in serious trouble. When you see that, you have to pay attention. So it's interesting. The whole idea of dividend investing has really gone in and out of fashion over the years. Its popularity has been pushed and pulled by things like tax laws and just the general mood of the market. Let's take a quick look at that history, because it really tells us why dividends matter so much right now. So if you go back to the 80s, dividend taxes were incredibly high, sometimes up to 70%, so nobody wanted them. Then in the 90s, during the dot-com boom, it was all about growth, growth, growth. By 1999, dividends were a tiny fraction of the market's return. But then, the bubble burst. And in 2003, tax laws changed, making dividends much more attractive. After the dot-com bust and then the 2008 financial crisis, investors got a couple of really painful reminders that paper profits can vanish in a heartbeat, but cash in your hand is real. That brings us to the 2020s.
With all the market volatility we've seen and a huge generation of baby boomers retiring, the demand for stable, reliable income is back in a big way. And this right here is a huge piece of the puzzle. By 2030, it's expected there will be 71 million Americans aged 65 and older. Think about that. As millions and millions of people in the baby boomer generation move from their working years into retirement, their financial priority number one shifts. It's no longer about chasing maximum growth, it's about generating stable income to live on. That huge demographic wave is creating an enormous and growing demand for exactly the kind of investments we've been talking about. So, at the end of the day, it all comes back to a simple question. We saw what happened with our two investors. One took the immediate cash, the other put it back to work to build something much bigger. So which one will you be? A party Pete or a frugal Faye? Understanding how dividends work gives you that choice. It gives you another powerful tool to shape your own financial future. All right, welcome. You know, if you're trying to build a portfolio that actually works for you, one that generates a steady stream of income, then you are in exactly the right place. Today, we're going to go on a bit of an expedition, an adventure really, to hunt down those reliable income streams that are hiding out there in the stock market.
So here's our game plan, our expedition map, if you will. We're going to hit 4 different territories, each one known for paying out steady income. We'll start with the bedrock, utilities. Then we'll tap into the wellspring of energy. After that, we'll check out the network with telecoms. And finally, we'll stock the pantry with consumer staples. It's going to be a good trip.
Okay, so what's the real goal here? What are we trying to accomplish? Well, it's really about a shift in how you think about investing. It's easy to get caught up in chasing those hot stocks, the ones with skyrocketing growth. But today, we're taking a different approach. We're learning to appreciate the quiet power of those solid, mature companies. You know, the ones that consistently pay you back for being an owner. All right, let's get into it. Our first stop on this expedition, the utilities sector. I want you to think of this as the absolute bedrock. It's the foundation that so many solid income portfolios are built on. These are the companies that literally keep the lights on and the water running. So, utilities are really a fascinating case of give and take. On the one hand, you get incredible stability, right? They're what we call natural monopolies. It would be kind of crazy to have 2 different sets of power lines running to your house. So that means they have super consistent revenue and almost guaranteed profits. But, and this is a big but, that stability comes with a price. They're heavily regulated by the government, and they have to take on enormous amounts of debt to build and maintain all that infrastructure. And that debt, that's the key thing to watch. It makes them really sensitive to interest rate changes, and we'll see why that matters in a sec. Okay, so if this is our bedrock territory, how do we explore it safely? What are the signs we need to look for? Well, there are a few things. First, obviously you want to see consistent dividend growth over time. And it's usually a safer bet to stick with the pure play utilities, not the ones dabbling in weird side ventures. But the single most critical thing to track, it's that debt load. A utility with debt over, say, 60% of its total capital is a potential red flag. Why? Because when interest rates go up, their debt payments go up too, and that can really squeeze their profits. That's the hidden danger you've got to watch out for.
All right, expedition time. Let's pack up from the steady bedrock and head into our next territory, the energy sector. Now, this place, it's a whole different animal. It's powerful, it's essential, but man, can it be a volatile landscape for an income investor. Things are definitely about to get more interesting. You know, the whole story of the energy sector really boils down to one simple tension. On the one hand, our entire modern world runs on this stuff. That creates massive, unending demand and a huge opportunity for investors. But that same reliance means the price can be all over the map. One event halfway around the world can send prices through the roof or crashing to the floor. And because it's so important, you've always got that background risk of government stepping in and changing the rules.
So that brings up a really interesting question. What if you could find a company that didn't have to pay corporate tax and just passed all its cash flows straight to investors? Sounds too good to be true, right? Well, that question is the key that unlocks a special kind of tool for investing in energy. It leads us right to something called a Master Limited Partnership, or MLP for short. So, what in the world is an MLP? Okay, think of it this way. It's a special business structure, and it's designed to fix a huge problem for investors called double taxation. See, with a normal company, the corporation pays taxes on its profits, then it pays you a dividend, and guess what? You get taxed on that money again. It's a double whammy. But MLPs, They get a pass. They don't pay corporate tax. The money and the tax bill flows directly to the investors, the unit holders, and that can mean a lot more cash in your pocket. So why would you even bother with this? Well, the appeal is pretty huge. First off, MLPs are required by law to pay out almost all of their cash flow. That can lead to some massive yields. And second, and this is really cool, a lot of them work in the midstream part of the business. We're talking pipelines, storage tanks. They're like the toll roads of the energy world. Their income is based on how much oil and gas they move, not the crazy up and down price of it. That gives you a layer of stability you just don't get with a regular oil drilling company. Okay, but there's always a catch, right? And with MLPs, it's a pretty big one. That amazing tax advantage comes with a real headache. Your taxes get complicated. You get a special tax form. You might even have to file in multiple states. It can be a mess. Plus, as a limited partner, you're basically a passenger, not a driver. You put up the money, but you have almost zero say in how the company is actually run. Okay, time to move on. Our expedition is now entering the world of telecommunications. And let me tell you, this territory has changed a lot. This used to be a sleepy, safe little corner of the market for income investors. Not anymore. It's a whole new world. You know, if you go back a few decades, telecom companies were pretty much just like utilities. They were safe, predictable, regulated, easy. But today, forget about it. It's an all-out war. You've got intense price competition, technology changing every 5 minutes. It's a total battleground. Sure, they still get that steady revenue from your monthly bill, but they have to pour billions into network upgrades just to stay in the game. And customer loyalty? That's pretty much gone. So, in a landscape this competitive, just looking at the dividend yield is a huge mistake. It's not enough. To really figure out if a telecom company is healthy, you have to become a tracker. You've got to follow the signs. And there are 4 key vital signs we need to watch. Subscriber growth, something called the churn rate, average revenue per user, or ARPU, and free cash flow. Looking at these 4 things together is the only way to know if a company is actually thriving or just slowly bleeding out.
Let's start with maybe the most important one, the churn rate. Sounds fancy, but it's really simple. It's just the percentage of customers who are jumping ship and leaving for a competitor. In a world where you can switch your phone service in about 10 minutes, a low churn rate is a really, really good sign. It tells you the company is doing something right and keeping its customers happy.
But here's where you have to be smart. You can't just look at churn by itself. You have to compare it to how many new customers they're getting. So let's say a company has a churn rate of 2.1%, but they're only growing new subscribers by 1.4%. What does that mean? It means they're losing more customers than they're gaining. They're shrinking. It's like trying to fill a leaky bucket. No matter how much water you pour in, the level keeps going down. That is a massive red flag for any income investor. All right, for our final stop on this expedition, we're heading to a territory that's probably the most familiar to all of us. We're going to stock the pantry. We're talking about the companies that make the stuff you buy every single day. The things you use whether the economy is good, bad, or sideways. Okay, in this whole consumer space, there's one critical distinction you have to get. It's wants versus needs. So you have consumer cyclicals. These are the wants. Things like a new car, a fancy vacation, a big screen TV. People buy that stuff when they're feeling good about the economy. And then you have consumer staples. These are the needs. We're talking food, toothpaste, soap, coffee, the stuff you buy no matter what. And for income, we're focused squarely on the needs. So think about it. People don't stop brushing their teeth or drinking coffee during a recession, right? That's why these companies are called defensive stocks. Their demand is non-cyclical. It's steady. That steady demand leads to incredibly predictable cash flow. And predictable cash flow is what makes reliable dividends possible. They're called defensive for a reason. They help defend your portfolio when the rest of the market is going crazy. And there we have it. Our expedition is complete. We've surveyed 4 very different territories for income investing. We saw the solid, stable bedrock of utilities, the gushing but volatile wellspring of energy, the cutthroat, competitive network of telecoms, and the reliable, steady pantry of consumer staples. So let's lay out our map one last time and see what we've learned. This little field guide here really puts it all into perspective, doesn't it? It's all about the trade-offs. You want rock-solid stability? Look at utilities, but don't expect much growth. You want more growth potential? Well, energy and MLPs have that, but you've got to be okay with the price volatility. Telecoms are kind of that middle-of-the-road option. And consumer staples, they give you great stability, maybe with a little more growth than utilities.
This is the kind of map that helps you figure out where you even want to start looking.
Look, the most important thing to take away from all this, and this is a direct quote from the source material, is that you should never just follow recommendations, not even mine, without doing your own homework. Think of this as your field guide. It's a map that shows you the terrain, but you're the explorer. The real adventure, the real investigation, that's on you. So now you've got the map. The question is, which territory are you going to explore first to build your own income stream? Are you looking for that fortress-like stability you get from the bedrock of utilities? Or are you willing to drill into the more volatile, but potentially more rewarding, wellspring of energy? The map is in your hands now. The real journey starts here. All right, let's get right into it. Today we're talking about two sectors that, for a lot of dividend investors, are kind of like ghosts of portfolios past: real estate investment trusts, or REITs, and banks. You know, these are what some folks call the has-beens of dividend investing. But the real question is, after the massive storm they went through, is there some hidden value left in the wreckage? Let's find out. To really get why these sectors have such a bad reputation, you gotta rewind the clock. Back in 2006, 2007, the housing bubble just popped. That absolutely crushed the REITs. And that, of course, triggered the 2008 financial crisis, which took a wrecking ball to the entire global banking industry. By 2009, dividend cuts weren't just happening here and there, they were everywhere. Some banks wiped out their dividends completely, and that scarred a whole generation of income investors. But you know, here's where the story gets really interesting. That whole crisis, as awful as it was, acted like a massive stress test on the entire market. And yeah, a lot of companies failed that test. But a handful of really strong survivors in both sectors managed to make it through the storm. I mean, think about it. A REIT that kept paying a steady dividend through all of that, that says something really powerful about its management and the quality of its properties. That kind of resilience is exactly what we're looking for. So here's the game plan. First, we're going to tackle this whole idea of investing in these so-called has-beens. Then we'll dive deep into REITs, see if they really are like being a landlord without all the headaches, and I'll give you a toolkit to analyze them properly. Finally, we'll switch over to the banks and learn how to actually measure their financial strength in today's world. All right, first up, REITs. You know, the idea behind them is super appealing. You get the promise of that steady real estate income, but you don't have to fix leaky toilets at 2 a.m. or chase down tenants for rent checks. So let's break down what these things actually are. So at its core, a REIT is just a company that owns, operates, or sometimes finances real estate that generates income. When you buy a share, you're literally buying a tiny piece of a whole portfolio of properties. Could be office buildings, apartment complexes, shopping malls, you name it. It's set up as a trust, and you, the shareholder, are the beneficiary. Probably the best way to wrap your head around a REIT is to think of it as a hybrid. On one hand, it trades just like any other stock. You can buy and sell it anytime the market's open, which makes it super liquid. But on the other hand, it acts a lot like a mutual fund. Instead of a basket of different stocks, it's a professionally managed basket of properties, which gives you instant diversification across the real estate market. Now, for us dividend investors, this slide right here shows the main event. Look at that top bullet point, that 90% figure. That's the number one reason people love REITs. See, by law, to keep their special tax-exempt status, they have to pay out at least 90% of their taxable income to shareholders as dividends. It's not a suggestion, it's a rule. And that's why they so often have those juicy, higher-than-average yields. But of course, it's not all sunshine and dividend checks. That high-yield potential comes with its own very specific set of risks. Because you're basically investing at the intersection of Wall Street and Main Street, the stock market and the real estate market, you get exposed to the potential downsides of both. So it's really crucial to understand what you're getting into. If the economy takes a nosedive and offices start to empty out, that hits a REIT's revenue directly. And their share prices, they can get dragged down in a broad market sell-off, even if their actual properties are doing just fine. And man, are they sensitive to interest rates. When rates go up, it gets more expensive for them to borrow money to buy new properties. Okay, this brings us to what I think is the most important part of our talk on REITs, how you actually figure out if one is a good investment. You know, just using standard stock metrics like earnings per share, well, it can be seriously misleading here. You need a special toolkit to see what's really going on under the hood. All right, if you take only one single thing away about how to analyze REITs, please make it this. We have to look past the normal net income number and focus on a metric that gives us a much more accurate picture of a REIT's ability to keep paying that dividend. And that metric is called
funds from operations, or FFO for short. Just think of it as a cash flow measure designed specifically for real estate companies. See, standard accounting makes companies subtract depreciation, which is a non-cash expense. But that doesn't make sense for real estate, which usually appreciates in value over time. FFO basically fixes that accounting distortion.
And the calculation itself is pretty simple, actually. You just start with the company's net income from their financial statement. Then you add back that big depreciation number. And finally, you subtract any one-time profits they made from, say, selling off a building. The whole goal is just to isolate the steady, repeatable cash flow they're making from their main business, which is renting out properties.
Now, this little case study is brilliant because it shows you exactly why FFO is so critical. Let's look at our fake company here, Big Edifice Realty. The dividend they're paying is 42.6 cents a share. Now, if you compare that to its net income of only 29 cents a share, you get a payout ratio that looks completely insane. But when you compare that same dividend to its FFO of 52 cents per share, the picture changes a lot. A 147% payout ratio? I mean, that's a 5-alarm fire. That would send any sane investor running for the hills. It means the company is paying out way, way more in dividends than it's actually earning in profit. Based on this number alone, you'd think a dividend cut is right around the corner. It looks like a complete disaster. But now, look what happens when we use the FFO-based calculation, an 82% payout ratio. Now, is that high? Yeah, sure, but it's totally normal for a REIT, and most importantly, it's sustainable. The company is actually generating more than enough cash from its operations to cover that dividend. This is the difference between blind panic and smart analysis. So here's something practical you can take with you. When you're doing your own research on a REIT, calculate that payout ratio using FFO. A good rule of thumb is to look for a ratio below 85%. That's a pretty good sign. It tells you that management has a nice safety cushion and isn't stretching itself too thin just to make the dividend payment.
Okay, let's switch gears and talk about our second has-been sector, the banks. And just like with REITs, that 2008 crisis completely changed the rules of the game. Bank balance sheets can be ridiculously complex, right? So after the crisis, the dividend itself started to become a much more important signal of a bank's real financial health.
And the stakes here, well, they couldn't be higher. This quote is a pretty chilling reminder of what can happen. When Washington Mutual, which was one of the biggest banks in the country, went under, the depositors were protected by the FDIC. They got their money back. But the shareholders, they got completely wiped out, lost everything. This is why you absolutely have to do your homework in this sector. When you boil it all down, a bank's entire business is about managing two big fundamental risks. First, you've got interest rate risk. They make their money on the spread. That's the difference between the interest they pay you for your savings account and the interest they charge someone else for a mortgage. If that spread gets squeezed, their profits take a hit. And second is credit risk, the simple, unavoidable danger that the people they lend money to won't pay it back. So how do we actually check to see how well a bank is managing these risks? Well, this little checklist gives us 4 key gauges for our dashboard. First up is return on equity, or ROE. Think of this as a profitability score. How much profit is the bank making with the money shareholders have put in? You want to see that above 15%. Next, the equity to assets ratio. This is a safety measure. It's the bank's cushion, its shock absorbers against unexpected losses. Look for a number over 8%. Then there's the efficiency ratio. This tells you how much it costs the bank to make $1. Lower is better here. A lean, mean bank will be under 50%. And finally, the charge-off ratio. This is the painful one. It's the percentage of loans the bank has just given up on ever collecting. You want to see this number as low as possible, ideally under 1%.
And beyond those numbers, there are a couple of really simple red flags you can use to weed out the riskiest players right away. If a bank needed a government bailout just to survive the last crisis, just take it off your list. And if they cut their dividend back then and still haven't brought it back to where it was, that's another huge signal to just stay away. A dividend cut is a sign of weakness you just can't ignore. And that really brings us to the main point of this whole thing. Whether we're talking about REITs or banks, a bad reputation for an entire sector can cause investors to completely miss the really resilient, high-quality companies that actually survived the fire. The crucial point is that if you use the right tools, like FFO for REITs and that key ratio checklist for banks, you can look past all the noise and find the real story for yourself. So I'll just leave you with this one last thought to chew on. When it comes to investing,
where do you think the biggest risk is really hiding? Is it in the assets that everyone is scared of, the ones that have already been through the ringer? Or is it in the popular, crowded investments, the ones where everybody feels perfectly safe? It's something to think about. You know that feeling when you're standing in the cereal aisle and you're just overwhelmed by all the choices? Well, diving into dividend investing can feel a lot like that. So in this explainer, think of us as your personal guide. We're going to walk through the supermarket of investment options together. And by the end, you'll have a much better idea of which box or which vehicle is the right one for you. And this quote it nails it, doesn't it? It really boils down to this. Are you the kind of person who wants one big box of your favorite trusted brand? Or are you more of a variety pack person, someone who likes to spread things out a little? There's really no wrong answer here, but figuring out your personal style, that's the critical first step. So let's grab a cart and get started. So here's our map for the tour today. First, we're going to get the lay of the land in what we're calling the investor's supermarket. Then we'll take the most direct route possible with something called DRIPs. After that, we'll check out the managed portfolios, mutual funds. From there, we'll look at the modern hybrid, ETFs. And to finish up, we're going to expand our horizons and go global. Okay, so just picture it. You walk into this huge store, and the shelves are lined with all these different ways to invest your money. You've got DRIPs, you've got mutual funds, ETFs, the list goes on. Now, our goal here today is not to tell you which one to buy. Instead, we're going to teach you how to read the labels so you can understand exactly what's inside each of these packages and make the best choice for yourself. So let's start with this term, dividend investment vehicle. I know it sounds kind of technical, but it's really just a fancy way of asking, how do you want to own your stocks? Think of it like your shopping cart. You can fill that cart by going straight to the farmer, so to speak, or you could grab a pre-made basket of goods right off the shelf. Each way has its own pros and cons, and we're about to explore them. All right, our first stop, we're going straight to the source with what are called DRIPs. That stands for Dividend Reinvestment Plans. If we're sticking with our analogy, this is the farm-to-table of investing. You're basically cutting out the middleman and buying your shares directly from the company itself. Let's see what that really means. So a DRIP really boils down to two incredibly powerful features. Number one, you buy your shares direct from the company, no broker. And number two, and this is the big one, your dividends are automatically put to work buying you even more shares. It's like this little automated growth engine that you just set up once and then let it run on its own. And the benefits of this approach are pretty compelling. You can often start with a very small amount of money, and you can save a ton on broker fees. It's a disciplined way to invest because it takes your emotions out of the equation. Plus, you get to buy fractional shares, which means every single penny you earn is put to work. And it automates something called dollar cost averaging. That just means you're buying consistently over time, which can really smooth out the market's bumps. But the real secret weapon here, the absolute magic of a DRIP, is compounding. See, the dividends you earn buy more shares, which then earn their own dividends, which buy even more shares. It's this incredible snowball of wealth that just keeps getting bigger and bigger as it rolls downhill over time. It is the ultimate set-it-and-forget-it wealth-building machine. Okay, but it's not all perfect. There's always a catch, right? With DRIPs, you give up some control. You buy on the company's timeline, not when you necessarily want to. And selling, it can be really slow, taking weeks sometimes. Some DRIPs do have fees, and you still have to pay taxes on those dividends, even though you never actually saw the cash. But the biggest problem? Well, that's a whole other level of headache. Let's just be blunt about this. The paperwork involved with DRIPs can be an absolute nightmare. Seriously, every tiny dividend payment, every little fractional share purchase, you have to track the cost basis for all of it. For tax purposes, potentially for decades, it can turn into a mountain of statements and spreadsheets that can just completely overwhelm you. All right, let's head to the next aisle in our supermarket, mutual funds. Now, if DRIPs are like going farm to table, you can think of mutual funds as one of those popular meal kits. You know, all the different ingredients are picked out for you, they're pre-portioned, and they're delivered right to your door. It's basically diversification in a box. The concept is actually really clever. An investment company creates a fund, and then you, me, and thousands of other people all chip in and pool our money together. A professional manager then takes that giant pile of cash and invests it across dozens, sometimes hundreds of different stocks. So with one purchase, you own a tiny little slice of that whole big portfolio. But of course, there's a trade-off. It really comes down to convenience versus cost. On the pro side, you get instant diversification and a professional managing your money. It's simple. But on the con side,
You pay for that convenience through fees. You give up some control, and you can get hit with surprise tax bills from something called pass-through capital gains. It's like the fund manager throws a party, sells some stock for a profit, and then you get stuck with part of the tax bill.
So let's talk about those costs for a second. Every single mutual fund has what's called an expense ratio. That's the annual fee you pay, and it's taken right out of your investment. As you can see, the biggest slice of that fee usually goes to the manager. But then you also have other costs, like marketing fees and operating expenses. They all add up, and they directly reduce your investment returns year after year.
And on top of that annual expense ratio, you have to watch out for something called loads. It's just a fancy word for a sales commission. A front-end load is a fee you pay when you buy in. A back-end load is a fee you pay when you sell. Ideally, you want to find a no-load fund, which, you guessed it, has no sales commission at all. The bottom line is pretty simple. The lower the fees, the more of your own money you actually get to keep. Okay, time for our next stop. If mutual funds are the established meal kit, then exchange-traded funds, or ETFs, are kind of like the newer, more high-tech version. They're this really interesting modern hybrid that takes some of the best features of mutual funds and combines them with the flexibility of trading an individual stock.
So here's the absolute key difference you need to understand. An ETF, just like a mutual fund, is a basket of different stocks. But, and this is the game changer, it trades on a stock exchange all day long, just like a share of Apple or Microsoft. And that one single distinction makes all the difference in the world.
Let's put them side by side. Mutual funds, they only trade once per day at whatever the closing price is. ETFs, you can buy and sell them any second the market is open. ETFs also tend to have much lower fees and are way more tax efficient. Plus, with an ETF, you can see exactly what you own every single day, instead of just getting a peek at the portfolio once a quarter. And if you want to see just how much those fees matter, take a look at this chart. According to the data, the average mutual fund costs about 1% per year. The average ETF, just over 0.5%. Now, that might not sound like a huge difference, but think about it. On a $100,000 investment, that's almost $500 every single year that stays in your pocket. Over a few decades, that adds up to a serious amount of money. All right, for our final stop on this tour, we're heading over to the international aisle. You see, up until now, we've really only been talking about U.S. stocks. But in today's world, if you limit yourself to just one country, you could be missing out on a huge world of opportunity. Just look at that number on the screen, 70%. What do you think that represents? Well, get this. That is the percentage of all stock dividends paid out across the entire planet that come from companies outside of the United States. Let that sink in. If you're only investing at home, you are fishing in a pond that has less than a third of all the fish. So why would you want to go global? Well, for one, you can tap into economies that are growing faster than our own. You can often find much higher dividend yields, and it can be a great way to protect yourself if the US dollar gets weak. But you have to be aware of the risks. Things like currency fluctuations and foreign taxes can definitely be a factor. Still, the potential rewards are pretty hard to ignore.
Now, I know what you might be thinking. Investing overseas sounds really complicated. And you know what? It can be. But there's a surprisingly simple way to get started. It's called an American Depository Receipt, or an ADR. Basically, a big U.S. bank will go buy a bunch of shares of a foreign company, say Toyota, and then they'll issue a certificate that trades right here on a U.S. stock exchange in good old U.S. dollars. It's an easy way to own a piece of a global giant.
And with that, our tour comes to an end. We've looked at the powerful automated approach of DRIPs, we've seen the convenience of mutual funds, and we've checked out the low-cost, flexible world of ETFs. So at the end of the day, the question isn't which one of these is the best. The real question you have to ask is, based on your own goals, your personality, and how much work you want to put in, which one of these is the best for you?
All right, let's talk about something really important. We're not just going to talk about stocks and bonds today. No, we're going to build your personal blueprint for your financial future. Because look, before you even think about putting $1 in the market, you've got to have a plan. You need a roadmap that connects your money to your actual life. This is the stuff that makes all the other stuff work. So let's get right into it.
So let me ask you a question, and I want you to really think about it. Why are you really doing this? Let's be honest, nobody's investing just for the fun of watching numbers go up and down on a screen. Are you doing it to buy that lake house you've always dreamed of? Or maybe it's to make sure your kids can go to college without being buried in debt. Or is it the big one?
a retirement where you don't have to worry about a single thing. Nailing down your why is step number one, and honestly, it's the most important step of all.
And this quote, it just nails it, doesn't it? Think of your investments as a tool, like a power drill. You don't buy a drill because you love drills, you buy it to build something awesome, like a deck for your family. It's the same with stocks. The goal isn't just to have more money. The goal is the freedom, the choices, the life that money can help you build.
Okay, so here's our game plan for today. First, we're going to talk about why you even need a plan in the first place. Then we'll get into who you are as an investor. This is crucial. After that, we'll define what your goals actually are, map out how to create your plan, and finally, we'll look at the tools you need to build it all, especially for retirement. So, first things first, why you absolutely 100% need a plan. And this isn't about being neat and tidy. It's about not wasting your two most precious assets, your time and your money. A plan is the foundation you build everything on. Without it, you're not investing. You're just guessing.
I love this saying because it's so true. Can you imagine packing up the car, getting the whole family ready, and just starting to drive with no idea where you're going? You just burn gas and waste time until everyone's frustrated. It sounds crazy, right? But that's exactly how a lot of people approach their money. A plan gives you a destination. It gives you the GPS to get there.
Okay, now we get to the really interesting part. This is all about you. See, before you pick an investment, you have to pick a strategy that actually fits your personality. If you're a cautious person, a super risky strategy is going to keep you up at night, guaranteed. And if you're okay with some risk, a super safe one is going to feel like you're going nowhere. So we've got to figure out, what kind of investor are you?
First, we've got the saver, and really we all start out as savers. For a pure saver, the number one rule is don't lose my money. Their goal is capital preservation. That's just a fancy way of saying they want to make sure every dollar they put in is still there later. They like safe things, like savings accounts and CDs. And that's great for peace of mind. But the downside is very little growth. And the secret enemy here is inflation, which quietly eats away at your money's buying power over the years.
Now, on the total opposite side of the universe, you have the speculator. A speculator doesn't really care about the company or its long-term prospects. They're all about those wild short-term price swings. They're trying to jump in, make a quick buck, and jump out, usually based on some hot tip. And as you can probably guess, this means they're putting their original investment at huge, huge risk. And let's just call it what it is. It's basically gambling. You're betting on which way a stock is going to move in the next day or week. It's incredibly unpredictable. Remember the people flipping houses back in '06 and '07? They were betting prices would go up forever. When that bet went bad, a lot of them got completely wiped out. That's speculation. It's a high-stakes game, and it is not long-term investing.
And then we have the investor. For pretty much everyone trying to build real wealth over time, this is the sweet spot. An investor is a mix of the other two. They want to protect their money like a saver, but they also want it to grow in a meaningful way. And the secret ingredient? It's time. Investors are in it for the long haul. We're talking 5 years minimum, but usually it's decades. That time lets you ride out the bumps in the market and let the magic of compounding do its work.
Now, even within the investor camp, there are different flavors. You have the conservative investor, whose main goal is to protect what they've got. They'll have maybe half their portfolio or less in equities, which, by the way, is just Wall Street speak for stocks. Then you have the aggressive investor. They're shooting for maximum growth, so they might have 70% or more in stocks. Now, one isn't better than the other. The right one just depends completely on you.
So what's the deciding factor? How do you know if you should lean conservative or aggressive? Well, it mostly boils down to one simple thing: your time horizon. How much time do you have? If you're in your 20s or 30s, you've got decades ahead of you. A market crash is actually a good thing. It's a massive sale. But if you're 62 and you want to retire at 65, you have way less time to recover from a big loss. For you, protecting your money becomes priority number one.
Okay, so you've got a handle on your investing style. Now let's get back to that destination. Remember the road trip? This is where we pick a spot on the map. We stop talking about ideas and we start getting really specific about what we're building towards. This is where the rubber meets the road. It helps to break your goals into 3 different time buckets. First, you've got short-term goals. These are things you want in the next couple of years. A new car, that big trip to Italy. Money for these goals needs to be kept safe, not in the stock market. Then you've got your intermediate goals, maybe 2 to 5 years out. Think a down payment on a house. And finally, the long-term goals. Anything 5 years or more down the line, like your kids' education and, of course, your retirement.
And listen, a new car is fun. A vacation is great. But let me be really clear about this.
For almost every single person, a comfortable retirement has to be the #1 long-term goal. It's the big one. It's the goal that makes sure all your decades of hard work actually pay off in the end, with security and freedom. It's the foundation for everything else.
So, we know our style, we know our destination. What's next? Well, now it's time to actually draw the blueprint. This is the practical, step-by-step part. We're going to map out exactly how you get from where you are today to where you want to be. This is where the plan really comes to life. And look, the plan itself is just 4 simple steps. First, get specific. How much do you need and by when? Second, run the numbers. There are tons of free calculators online that will tell you how much you need to save each month to hit your goal. Third, and this is the most important habit you can build, pay yourself first. You set it up so the money automatically goes into your investments from every paycheck. It's a total game changer. And fourth, you have a simple budget to make sure you can stick with the plan.
All right, for our last section, let's open up the toolbox. We've got the blueprint, now we need the right tools to build this thing, especially for that #1 goal, retirement. I know all the different accounts can seem complicated. 401ks, IRAs, it sounds like alphabet soup, but stick with me, we're gonna make it really simple. But before we get into the accounts, we need a quick reality check. You know, my parents' generation, a lot of them could count on a pension from their company. For most of us, those days are over, and who knows what Social Security will look like. The hard truth is, the only money you can 100% count on for your retirement is the money you save yourself. It's all on us now. So here are the main tools in the toolkit. The big one for many people is the 401k. That's the one you get through work. You put money in before taxes, which lowers your tax bill today. Nice. An IRA is an individual retirement account you open yourself. A traditional IRA works a lot like a 401k. Now the Roth IRA, this one is amazing. You put in after-tax money, so no break today. But all of your growth and all your withdrawals in retirement are 100% tax-free. It's a huge deal. And finally, a regular brokerage account gives you total freedom but no special tax breaks.
Okay, I need everyone to listen closely to this part. If you remember one thing about 401ks, make it this. If your company offers to match what you contribute, you absolutely, positively must contribute enough to get that full match. It is literally free money. Not doing it is like turning down a 100% return on your investment, guaranteed on day one. Please do not leave that money on the table.
So, that's it. We've gone through the whole process. The why is your dream for your life. The who is your personal investing style. The what are your specific goals. And the how is the plan and the tools to make it all happen. You have all the pieces of the puzzle right in front of you. So the only question left is, when are you going to sit down and start drawing your blueprint?
You know, what if I told you the absolute safest place for your money is also a guaranteed way to lose it? Sounds crazy, right? But stick with me, because by the end of this, you'll see exactly why that's true. Today, we're going to tackle a word that makes a lot of people, well, pretty nervous: risk. But we're not going to treat it like something to run away from. Nope. We're going to see it for what it really is: a variable in an equation. It's something you can understand, you can measure, and most importantly, something you can manage. Let's get into it. Okay, let's just think about this for a second. Getting married, starting a brand new business from the ground up, heck, even just driving your car to work. What's the one thing that connects all of them? They're all risks, every single one. But we take them, right? The real question isn't if we take risks, it's why. It's because the potential reward feels worth it. Simple as that. The shot at lifelong partnership, the dream of being your own boss, or just getting home safely with your groceries. We are constantly, usually without even thinking about it, doing a quick calculation in our heads. Is the potential upside bigger than the potential downside? Well, that exact same mental math is what we need to bring to our money. And this is where so many people get tripped up. They think the safe play is to just park their money in a savings account and forget about it. But as we're about to see, that's a risk. And investing in the market? Yeah, of course, that's a risk too. The reality is, when it comes to your money, there is just no way to completely sidestep risk. It doesn't exist. So let's get one thing straight right now. The goal here isn't to find some magic risk-free investment. It's a myth. The real goal is to become an intelligent manager of risk. It's about understanding the trade-offs, getting to know yourself, and then using proven strategies to tilt the odds in your favor. All right, let's dive in. So where do we even begin?
We start with what is basically the fundamental law of the entire investing universe, the relationship between risk and reward. Think of them as two sides of the very same coin. You just can't have the potential for a big reward without being willing to accept some level of risk. Okay, let's get super clear on a definition here, because words really matter. In the world of finance, risk isn't just some vague, scary feeling. It is the measurable possibility of losing money. This is so important because it separates risk from uncertainty. For instance, we can look at a stock's history and literally measure how much its price has bounced around. That's risk. What we can't measure is a surprise global event or a new invention that changes an entire industry overnight. That's uncertainty. We can't do much about uncertainty, but we can absolutely analyze and manage risk. This chart right here shows that risk-reward equation in action perfectly. See that really jagged black line way up at the top? That's stocks. All those wild ups and downs, that's risk you can actually see. But look where it ends up. Way, way higher than everything else. Now look down at those smoother, calmer gray lines. That's bonds and cash. A much less stressful ride for sure. Less risk, but also a whole lot less reward. And that little dotted line just crawling along the bottom, that's inflation. That's the silent thief that's always trying to eat away at the value of your money.
You know that jagged, bouncy ride we just saw with the stock line? Well, that has a name, volatility. It's really just a measure of how much an investment's price swings up and down. A stock that can pop up 10% one day and then drop 8% the next, that's highly volatile. A government bond that barely budges, not so much. In general, more volatility means more risk, and that volatility is basically the price of admission for the chance at getting those higher returns. And this brings us right back to that safe cash line on the chart. So what happens if you decide to take zero investment risk? Well, if inflation is running at, say, 4% and your savings account is paying you 1%, you are guaranteed to lose 3% of your buying power every single year. Let me say that again. Avoiding investment risk means you are accepting the certainty that your money will be worth less over time. It is a guaranteed loss. Okay, so we've established that taking some calculated risk is pretty much a requirement if you want your money to grow. But listen, not everyone is wired to handle that wild, volatile ride we saw. And that brings us to the most personal part of this whole discussion, you. It's trying to figure out your personal risk tolerance.
You don't need a fancy financial advisor for this. Just a simple thought experiment I call the sleepless nights test. And be brutally honest with yourself here. Imagine your entire investment portfolio drops 20% in a single month. It has happened. Could you look at that, understand that it's part of the game, and still sleep soundly? If the answer is yes, you've probably got a high tolerance. Do those big drops make your stomach flip and have you checking your phone every 5 minutes? That's probably average. Or does even a tiny 5% dip tie you up in knots and make you wish you'd never invested at dime? That's a low tolerance. And let me be clear, there's nothing wrong with that. Knowing this about yourself is one of the most powerful things you can know as an investor.
And this table here just lays it all out. It shows you the direct connection between how you answered that sleepless nights test and your likely outcomes. If you have a high tolerance, you're opening yourself up to the possibility of big wins, and yes, big losses. Low tolerance, you're choosing a path that's much more likely to deliver smaller, steadier returns, with a much lower chance of those gut-wrenching drops. There's no right or wrong answer here. The only right answer is the one that fits you and lets you stick with your plan for the long haul. All right, so now we get the risk-reward trade-off, and we've started to think about our own comfort zone. Now it's time to put on our detective hats. We've got to learn how to spot the different kinds of dangers an investor faces. Because here's the absolute key. Some of them we can manage, and some of them, well, we just can't. This slide really breaks it down. Over here, in this group, are the risks you can actually do something about. These are the internal things. They're about your knowledge, your own behavior, your strategies. Then, in the other group, you've got the big external forces of the world. You and I can't stop inflation. We can't tell the central bank what to do with interest rates. We certainly can't prevent a market crash. A smart investor doesn't waste a single ounce of energy worrying about the stuff they can't control. They focus all their effort on mastering the things they can control, to build a portfolio tough enough to survive the storms they know are coming. So of all those risks that you can control, this one is the big one. It is the silent portfolio killer, just plain old human error. And it's not about being smart or dumb. It's about being unprepared. Jumping into an investment because you heard a tip from a friend without doing any of your own research, that's human error.
Using a really risky strategy for a short-term goal, like saving for a house down payment you need next year, that's a classic human error. And the absolute biggest driver of all of them is that last one on the list, making decisions with your emotions instead of your brain. I want you to take a good look at this slide. Your emotions are your portfolio's single greatest enemy. Greed is what makes people pile into a stock when it's already shot up to the moon. Fear is what makes them panic and sell everything at the absolute bottom, turning a temporary paper loss into a permanent, real one. And then there's a weird one, love. You can't fall in love with a stock. A company's stock is not going to love you back. If the facts about the business change for the worse, you have to be disciplined enough to admit it's time to let go. Okay, we've identified the dangers, both the ones out there in the world and the ones inside our own heads. Now for the good part. This isn't just about spotting trouble. It's about actively dealing with it. So let's open up the toolbox and give you 4 professional-grade techniques to reduce your risk. First tool, and it's the most basic one you have, your timeline. I mean, think about it. If you're in your 20s or 30s, you've got decades before you'll need this money. That's an incredible advantage. It gives you time to recover from any market downturns, so you can afford to take on more volatility, more risk, chasing higher long-term growth. But what if you're 60 and you want to retire in 5 years? The game changes completely. Your number one priority is protecting what you've built. Your risk level has to come way, way down. Remember that number one risk factor we just talked about, human error? Well, here's the antidote. It's so simple. Do your homework. Being unprepared is a choice. Before you ever put a single dollar of your hard-earned money into a company, you should at least have a basic idea of what they do, how they actually make money, and who they're up against. A little bit of research is the single best defense against making a big mistake. Now, I know you've heard this a million times, but it's worth saying again because it is one of the most powerful risk management tools ever invented, diversification. It's that old saying, don't put all your eggs in one basket. If your entire life savings is tied up in one company's stock and that company hits a rough patch, you could be in serious trouble. But if your money is spread out across dozens of different companies, in different industries, even in different kinds of assets, a hit to any one of them won't sink your whole ship. Okay, let's get just a little more technical so you know how to diversify the right way. The key idea here is something called correlation. Let's say you own 10 different big tech stocks. You might feel like you're diversified, but if the whole tech industry has a bad year, they're probably all going to go down together. That's high correlation. Real powerful diversification comes from owning things that don't move in lockstep with each other, assets with low correlation. The classic example is stocks and high-quality government bonds. A lot of times, when people are scared and selling stocks, they're buying the safety of bonds. Their prices can move in opposite directions. That's low correlation, and that's the holy grail of building a strong portfolio. And our last technique is just a beautifully simple way to take your emotions and the temptation of bad timing right out of the equation. It's called dollar cost averaging. Instead of trying to be a genius and predict when the market is low, you just commit to investing a fixed amount of money at a regular time. Say $200 on the first of every single month. When prices are high, your $200 buys you fewer shares. But when prices are low, that same $200 buys you more shares. Over time, this automatically averages out your purchase price and saves you from the classic mistake of throwing all your money in right at the top of the market. After all of these charts and definitions and strategies, if you remember just one thing from this whole discussion, please let it be this. Don't risk money you cannot afford to lose. The money you need for next month's mortgage, for your emergency fund, or for your kids' tuition next year does not belong anywhere near volatile investments. End of story. So, we've pulled risk out of the shadows. We've reframed it. It's not some monster under the bed. It's a tool that can be understood, that can be measured, and that can be managed. We've looked at the market, we've looked in the mirror at ourselves, and we've put together a powerful toolkit of strategies. So the question is no longer, how can I possibly avoid risk? The real question, the much more exciting one, is this. Now that you understand how to manage it, what rewards are you going to choose to pursue? Thanks for watching. All right, let's talk dividend investing. You know, trying to get into it can feel, well, a bit like you're lost in the woods, right? So many choices, so many different gurus telling you what to do. It's just a lot of noise. So what we're going to do today is cut through all that. I'm going to give you a map, a compass, everything you need to find the strategy that actually works for you. Let's get into it. You know, the first thing that hits you is just the size of it all. The stock market isn't just big, it's absolutely massive. And when you're staring at thousands and thousands of options, the real question is, where do you even begin to look for the good stuff? How do you find those winners? And just to put a number on that, how about this one? As of March 2023, the U.S. stock market was worth, get this, $43.1 trillion. Trillion! I mean, that's more than double what it was back in 2007. And behind that giant number are thousands of companies, all vying for a piece of your investment pie. So that really brings us to the big question, doesn't it? You've got this ocean of over 4,000 publicly traded companies out there. How on earth do you sift through all of that to find the ones, the real winners, that are actually going to make you money? You know, how do you spot the gold and avoid the companies that are just going to drag your portfolio down? Well, we're going to tackle that exact question today. Think of this as our roadmap. First, we'll look at the big picture, the different ways you can even approach investing. Then, we'll get into the nitty-gritty of digging up info on companies. After that, we're going to learn how to read their financial reports, figure out if their dividend is actually strong, and then we'll wrap it all up with a checklist of what makes a really, truly good stock. All right, so first things first, before you even think about picking a single stock, you got to have a strategy. This is your philosophy, right? It's the set of rules that's going to guide every single decision you make. And generally, there are three main paths investors tend to follow. Okay, so here they are, the three big ones. You've got growth investing. Think of these guys as talent scouts, always hunting for the next big thing. They're all about companies growing like crazy, even if it means no dividends, because all the money's going back into the business. Then you have income investing. For these folks, it's all about the paycheck. They want that steady, reliable stream of cash from dividends. And finally, you've got value investing. These are the bargain hunters. They're looking for great, solid companies that the market has unfairly beaten down, they're on sale. But here's the kicker. You don't actually have to pick just one lane and stay in it. The real magic happens when you find a company that checks all three boxes. I'm talking about a company with explosive growth potential that also pays you a nice, steady dividend and is selling for a cheap price. Now that, my friends, is the sweet spot. It's the holy grail. So the million-dollar question is, how do you find these magical companies? Well, it takes a little bit of detective work. You have to do your homework. And your main source of intel? It's going to be the official reports that every public company has to release. Don't think of them as boring paperwork. Think of them as report cards that tell you exactly how a company's doing. And this is your essential toolkit right here. You've got the annual report. That's the nice, glossy version for shareholders. Then there's the 10K, which is kind of like the annual report, but with way more detail because it's for the SEC. The 10Q is just the quarterly version of that, so you can keep tabs on things. And then you have the 8K. And this one's a little different. And you absolutely cannot ignore the 8K. I mean it. An 8K gets filed when something major and unscheduled happens. We're talking a surprise CEO departure, a big merger announcement, even bankruptcy. A single 8K can drop a bombshell that makes all those other reports you just read completely useless. It's basically the breaking news alert for a company. Okay, so once you've got your hands on these reports, you got to know what you're looking at. This is where we dive into the numbers. We're going to look at the three big financial statements that, when you put them all together, give you a really clear picture of how healthy a company truly is. First up, we have the balance sheet. The easiest way to think about this is like a photograph. It's a snapshot of the company at one specific moment in time. It shows you everything the company owns, its assets, and everything it owes, its liabilities. It's pretty much the company's version of a personal net worth statement. And at the heart of the balance sheet is this one simple but really powerful equation. On one side, you have assets, everything the company owns, and that has to equal its liabilities, what it owes to others, plus the shareholder equity, which is what's left for the owners. The two sides of this equation have to balance, always. If they don't, well, something's very, very wrong. All right, next up is the income statement. You'll also hear it called the P&L, for profit and loss. Now, if the balance sheet was a photo, think of the income statement as a movie. It shows you what happened over a period of time, like a quarter or a full year. It starts with all the money coming in, the revenue, and then it subtracts all the costs. And what you're left with at the very end is the famous bottom line. Did they make a profit or not? And last but definitely not least, we have the cash flow statement. Now, this one is so important because it doesn't mess around with accounting rules. It just follows the cash.
real dollars. It tells you exactly where money came from and where it went. Just think of it like the company's checkbook register. And let me tell you, as a dividend investor, strong, positive cash flow is something you absolutely have to see. It's non-negotiable. Okay, so you've got the statements, you can read the numbers, but the numbers by themselves, they don't always tell you the full story. To really make sense of it all, you need to use financial ratios. These are the tools that let you compare companies and see what's really going on. They're like your compass for finding good value. And for anyone interested in income, this is probably your number one metric, dividend yield. All it is the annual dividend divided by the stock's price. It tells you, as a percentage, what kind of return you're getting just from the dividend. It's super useful because it lets you compare the income from completely different stocks, apples to apples. Next, we have a classic, the PE ratio, or price to earnings. This is all about valuation. It basically tells you how much the market is willing to pay for every dollar of a company's profits. So a really high PE means investors are excited, they expect big growth. A low PE, on the other hand, could be a sign that you've found a bargain.
And the math here couldn't be simpler. You just take the stock's price per share and divide it by its annual earnings per share. That's it. And that one little number is incredibly powerful for seeing how a stock's price stacks up against its competitors and the market as a whole.
So how do you actually use this thing? Well, a good rule of thumb is to look for a PE that's lower than the average for the whole market, which is usually around 18 or so. But, and this is key, you have to compare it to other companies in the same industry. A PE of 25 might be sky high for a bank, but dirt cheap for a tech company. Oh, and if you can't find a PE, big red flag. That means the E, the earnings, is a negative number. The company isn't making any money. Okay, this next one, the payout ratio, is another must-know for dividend investors. It answers one of the most important questions you can ask. Can the company actually afford to keep paying this dividend? It shows you exactly what chunk of the profits is being sent out to shareholders like you and what's being kept to grow the business. And hey, the math is easy on this one too. You just take the dividends per share and divide by the earnings per share. You're looking for a sweet spot here, maybe somewhere between 50 and 75%. That usually means the dividend is safe, but they still have money left over to grow. Now, if you see a ratio over 100%, watch out. That means they're paying out more in dividends than they're making in profit. That can't last forever.
So let's pull all this together into a final checklist. What are the signs of a great dividend stock? Number 1, rising dividends over time. That shows management is confident. 2, a strong balance sheet, which really means low debt. 3, good value. You don't want to overpay. 4, predictable cash flow. You need that cash to fuel the dividend. And 5, and this is a big one, management that's on your side, that acts like owners and does things to benefit you, the shareholder.
Whew. Okay, we have covered a ton of ground today. We went from big picture philosophies all the way down to the nitty-gritty of financial ratios. You basically have a full toolkit now to go out and analyze any dividend stock. So I'll leave you with this question. Now that you have these tools, what's the very first thing you're going to look for the next time you research a company? All right, everyone, let's talk about the first and, honestly, the most important decision you're ever going to make as an investor. It's not about what stock to buy, it's about who you're going to partner with to actually buy it. You see, you can't just call up Apple and say, I'll take 10 shares. You need a go-between, a broker. And picking the right one, well, that decision sets the stage for your entire investing career. So here's the game plan for today. First, we're going to tackle that one fundamental choice every single investor has to make. Then, we'll explore the 2 main roads you can take, hiring an expert guide or going it alone. After that, I'll give you a practical checklist so you can choose wisely. And finally, we'll get into the nitty-gritty of how you actually place your first buy and sell orders. Okay, let's jump right in. Your first big decision. Long before you're looking at stock charts, you're standing at a fork in the road, and the path you choose right here and now is going to define everything. How much help you get, how much you pay, and ultimately how much control you have over your own money. So it really all boils down to this one question. Do you want a professional co-pilot sitting next to you helping you navigate the turbulent skies of the market? Or are you the type of person who wants to be in the pilot seat, charting your own course, making your own calls? Look, there's no right or wrong answer here. There's only the answer that's right for you. You've basically got 2 camps. On one side, you've got the full-service broker. This is your expert guide, your financial advisor, your strategist. They're in it with you. On the other side is the discount broker. Think of them as the solo adventurers platform. They are there for one reason, to execute the orders you give them. You are the captain of the ship, for better or for worse.
So let's dig into that first option. What does it actually look like to partner up with a full-service broker, your so-called expert guide? Well, the upside is pretty obvious, right? You're hiring a pro. A good broker lives and breathes this stuff. They can save you a ton of time, a ton of energy, and a ton of worry. They've got access to research you don't. They can build a financial plan that covers way more than just stocks. And at the end of the day, you've got an expert watching your back. A really good one could end up making you far more money than you pay them in fees. But, and you knew there was a but coming, this expert help is not free. And there are some really serious traps you need to know about before you even think about signing up. This is a huge decision, and you need to go in with your eyes wide open. And the downsides can be pretty major. For starters, it's way more expensive. Those fees and commissions can seriously eat into your profits over time. A lot of these firms also have really high investment minimums, so they might not even talk to you if you're just starting out. But the biggest risk, the one you really have to watch out for, is the potential for a conflict of interest. This can lead to a nasty practice called churning. That's when a broker trades excessively in your account just to rack up commissions for themselves. And this right here, this slide gets to the absolute heart of that conflict. The difference between these two standards is night and day. A fiduciary is legally required to act in your best interest, period. It's like a doctor's oath, but for your money. But an advisor following the suitability standard, they just have to recommend something that's kinda sorta appropriate for you, not necessarily the best, and definitely not necessarily the cheapest. This is why that word suitability should be a massive red flag. It legally allows a broker to put you in a product that pays them a higher commission, even if there's a much better and cheaper option out there for you. It means their paycheck could literally be more important than your portfolio's performance. And this chart shows you exactly what that means in dollars and cents. Let's say you want to invest in a simple S&P 500 fund. A true fiduciary would find you one with a super low fee, maybe around 0.18%. But a broker on the suitability standard, they could sell you a fund that does the exact same thing but charges 1%. That's over 5 times more expensive, all because it puts more money in their pocket.
Okay, let's flip the coin. What if you want to be the one calling the shots? Let's talk about the do-it-yourself path, the world of the discount broker.
You know, the source material gives us the perfect way to think about this. A discount broker is like a cashier at a grocery store. You've already picked out what you want, they just scan it and take your payment. A full-service broker, on the other hand, is like that top-notch salesperson who's trying to guide you to the right purchase.
Now, the advantages here are pretty huge. It really boils down to two things: cost and control. The costs are incredibly low, sometimes just a few bucks a trade. And that whole conflict of interest thing we just talked about, poof, it's gone, because they don't care what you buy. You are in total control. Of course, that means your wins are all yours, but so are your losses. Now, it's easy to think that flying solo means you're totally out there in the dark, but that's not really the case anymore. Most modern discount brokers give you a whole arsenal of tools, research reports, stock screeners, educational videos to help you make smart decisions. You might be the pilot, but you've got a great dashboard in front of you. But here's the trade-off. The buck stops with you. There's no one to call for a second opinion. Every bit of research, every decision, it's all on your shoulders. And you still have to be careful. While the trade fees are low, you've got to read the fine print for things like inactivity fees or account maintenance fees that can sneak up on you. Okay, so we've looked at both sides. We've seen the pros and cons. Now let's get down to brass tacks. How do you actually make a smart choice for yourself? Here's your action plan. First things first, if you are thinking about hiring an advisor, you absolutely have to understand how they make their money. Fee only is the gold standard. It means you pay them directly, so their incentive is to help you. Fee-based is a murky middle ground. They get fees from you, but also commissions from products. And commissions, that means they're a salesperson, plain and simple, which creates the highest potential for a conflict of interest. Next, you got to do your own detective work. Don't just take their word for it. Start by asking people you trust for recommendations. Then, go to the website for the National Association of Personal Financial Advisors, NAPFA, to find certified fee-only planners. And this last one is an absolute must-do. Use FINRA's free broker check tool online. It'll tell you if an advisor has any complaints or disciplinary actions against them. It takes 5 minutes and it's non-negotiable. So here's the bottom line. You have to be direct. When you sit down with a potential advisor, you look them in the eye and you ask them 2 simple questions. How do you get paid? And are you a fiduciary? And then, and this is the important part, you get their answers in writing on a signed document before you hand over a single penny. Okay, final section. You've done the hard work, you've chosen your broker, congratulations. Now it's time to learn the language. Let's quickly run through the basic commands you'll be using to actually buy and sell stocks. Think of these as the 4 basic tools in your kit. A market order is the simplest. Get me in or get me out right now at whatever the price is. It's all about speed. A limit order gives you control. I'll buy it, but I am not paying 1 penny over $50. You set the price, but there's no guarantee your trade will happen. Then you have your safety nets. A stop loss is your emergency eject button. If the stock drops to this price, sell it automatically to stop the bleeding. And a trailing stop is even smarter. It's a safety net that follows your stock up, locking in your profits as it rises.
And finally, let's touch on something a little more advanced, shorting a stock. This is how you bet on a company's stock price going down. You're basically doing everything backwards. You borrow shares, sell them high, hope the price crashes, and then buy them back cheap to return them. Now, I have to be crystal clear here. This is a very high-risk strategy. When you buy a stock, the most you can lose is what you put in. When you short a stock, your potential losses are theoretically infinite. So, handle with extreme care. And that brings us right back to where we started. After looking at all of this, the pros, the cons, the risks, the rewards, which path sounds like you? Are you the kind of person who wants that expert guide by your side? Or are you the adventurer who's excited to grab the map and chart your own course? There's no wrong choice, but making the right one for you will make all the difference in the world.
You know, when it comes to investing, we all love to talk about the returns, right? The big wins. But here's the thing, successful investing isn't just about what you earn, it's really about what you get to keep after taxes. And that's exactly what we're going to break down today. The often confusing but absolutely critical world of dividend taxation, so you can make much smarter decisions with your money.
All right, let's dive in. First, we're going to tackle the most important question. Why should you even care about taxes on your investments? Then, we'll get into the secret to lower tax rates, something called qualified dividends. After that, we are going to decode those confusing tax forms you get from your funds. We'll navigate the really tricky territory of REITs and MLPs. And finally, I'll show you how to put it all together to really maximize what you take home.
So let's just start at the very beginning. Why does any of this really matter for you as an investor? Well, the answer is all about the hidden bite that taxes can take right out of your profits.
Just look at this example, an 8% gross return. That sounds fantastic, doesn't it? But if you're in, say, a 30% tax bracket, your real after-tax return plummets to just 5.6%. So instead of pocketing a cool $80 on a $1,000 investment, you're only walking away with $56. That difference is absolutely huge, especially when you think about how it compounds year after year.
So, what's going on here? Well, a crucial point to understand is this concept of double taxation. Think about it like this. A company earns a profit, and boom, the government taxes it at the corporate rate of 21%. Then, the company takes what's left and pays you, the shareholder, a dividend. And what happens next? You guessed it, the government taxes that same money again at your personal dividend tax rate. It's a real 1-2 punch that can seriously reduce the overall return on an investment.
Now that we see the problem, let's talk about the solution, or at least a way to soften that second tax punch. The tax code gives us a way, but only if your dividends are qualified. This right here is the key to getting a much, much lower, preferential tax rate.
And the difference this makes is, well, it's massive. Qualified dividends, they get taxed at the much friendlier long-term capital gains rates. We're talking 0%, 15%, or 20%, depending on your income. But non-qualified dividends, those get hit with your regular, ordinary income tax rate, which can be a whole lot higher. We're talking about a difference that can easily add up to thousands, maybe even tens of thousands of dollars over your investing lifetime.
But here's the catch. You knew there'd be a catch, right? To get that sweet lower rate, you can't just try to game the system. You have to meet a specific holding period. The key date to know is the ex-dividend date. That's basically the cutoff to be eligible for the next dividend. For regular common stock, you have to own the shares for more than 60 days during a special 121-day window that's centered on that ex-dividend date. So no buying it right before and selling right after. And for preferred stock, the rules are even tighter. The holding period is longer.
And this is exactly why meeting that holding period is so worth it. I mean, just look at these 2023 brackets. If you're married filing jointly and your taxable income is under about $89,000, your tax rate on qualified dividends is 0. Yes, you heard that right, 0%. And even for most middle-income folks, the rate is 15%, which is a huge discount compared to what they're paying on their regular salary. Okay, so we know what qualifies, but it's just as important to know what doesn't. Any dividends you earn inside an IRA or a 401k, those are out. They're going to get taxed as ordinary income when you eventually pull that money out in retirement. Payouts from money market accounts, most REITs and MLPs, and even some credit unions, those are typically non-qualified too. And of course, the big one. If you miss that holding period we just talked about, your dividend is automatically disqualified.
All right, let's switch gears a bit. How does all this apply when you invest your mutual funds or ETFs? Because let's face it, that's how most of us invest. This does add another layer of complexity, but it's something you really have to understand.
So at the end of the year, your brokerage is going to send you a tax form called the 1099 DIV. This little piece of paper has all the information you need, but you really have to know how to read it to make sure you're paying the right amount of tax. It's not always as straightforward as you might think.
First up, you'll see box 1A. This is your total ordinary dividends for the year. But, and this is important, don't stop there. This number is just a big mix of both your qualified and non-qualified dividends all lumped together.
Okay, now box 1B is where it gets really interesting. This box tells you the portion of your dividends that the fund considers qualified. Why? Because they met the holding period for all the stocks they own. But, and this is the critical part, this amount is only potentially qualified for you. You still have to have met your own holding period for the mutual fund shares themselves. If you bought and sold the fund too quickly, then sorry, none of it is qualified for you.
So you might be asking, where's the box for the non-qualified dividends? Well, surprise, there isn't one. You actually have to do a little bit of simple math yourself. You just subtract the qualified amount you see in box 1B from the total you see in box 1A. The number you're left with, that's the amount that's going to get taxed at your higher ordinary income rate.
All right, let's buckle up because we are now venturing into what I like to call expert-level tax territory. These are investments that often dangle some very attractive yields in front of you, but they play by a completely different set of tax rules. I'm talking about real estate investment trusts, or REITs, and master limited partnerships, MLPs.
REITs are a special kind of beast. The reason they exist is that they don't have to pay corporate income tax, but the trade-off is they have to pass along almost all of their profits to you, the shareholder. The catch for you, though, is that these payouts are almost never qualified. They're typically taxed at your higher ordinary income rate. Your tax statement will usually break it all down for you into ordinary income, capital gains, and something called return of capital.
Now that return of capital part, it can be pretty confusing. It shows up in your account, and it feels like tax-free cash in your pocket today, but it's not. It's really just a tax deferral. What it does is lower your cost basis. That's the original price you paid. So in this example, a $300 return of capital lowers your cost basis from $5,000 down to $4,700. What that means is when you eventually sell, your taxable profit is going to be $300 larger. You're really just pushing that tax bill down the road.
And then there are master limited partnerships, or MLPs. Before we even get into the mechanics, let me just give you a quick heads up. The tax situation with these things is notoriously complex. I'm talking about a real paperwork nightmare. Instead of a simple 1099 div, you get something called a Schedule K-1, and it can be a massive headache to deal with come tax time.
And listen, if you only take one thing away about MLPs, let it be this. This comes directly from tax experts everywhere. Do not hold them in a tax-deferred account like an IRA. I know, it sounds completely backward, doesn't it? But here's the deal. Because MLPs are partnerships, they can generate this weird kind of income called UBTI. Just think of it as business income that has no business being inside a retirement account. If you earn too much of it, your IRA itself could get hit with a tax bill. And that, well, that completely defeats the whole purpose of having an IRA in the first place.
Okay, so we've gone through a ton of rules, a bunch of exceptions, and a few pretty serious warnings. The big question now is, how do you take all of this information and actually use it to make smarter investment decisions, to really maximize what you get to keep? Well, it all boils down to this one simple formula. Your after-tax return is the only number that truly matters. You can't compare a REIT dividend to a qualified stock dividend or to a tax-free municipal bond without first running all of them through this calculation. This is what levels the playing field. It's what shows you what each investment is truly yielding for you.
And this chart just illustrates the concept brilliantly. At first glance, a bond that's yielding 9% seems way better than a dividend stock yielding 7%, right? But look what happens when you factor in the taxes. That bond, taxed at a high 35% ordinary income rate, gives you a real return of 5.85%. But the stock, with its dividend taxed at that much lower 15% qualified rate, actually puts more money in your pocket, with a real return of 5.95%.
Now, everything we've talked about today is really meant to give you a solid framework for how to think about taxes and your investments. But please remember, I am not a tax advisor, and the tax laws, well, they're always changing. Plus, your personal situation is completely unique, so please use this as a starting point, but always consult with a qualified tax professional to get advice that's tailored specifically for you.
So the big takeaway here is pretty simple. Always look beyond that headline yield. You have to consider the tax implications. So my question for you is this. Now that you have this framework for thinking about after-tax returns, what's the first investment in your own portfolio that you're going to go back and reevaluate? You know, when it comes to dividend investing, it really feels like everybody's got a strong opinion, right? On one side, you have people who swear by it, like it's practically free money just showing up in your account. And then on the other side, you've got the skeptics who think it's a complete waste of time. So let's get into it, because the real story, well, it's usually somewhere in the middle.
And that's really the big question we're going to tackle. Are these dividend stocks the golden ticket to building wealth, or are they just a distraction from where the real growth is? The opinions are so far apart, it can be really tough to figure out who to believe.
And this quote just hits the nail on the head. So our whole goal with this explainer is to just cut through all that noise. We're going to go through 10 of the most common myths out there to give you a really clear, balanced look at how this whole dividend thing actually works.
So let's start with maybe the biggest stereotype of them all. And look, I'll be honest with you, being 45 myself, I used to fall for this one too. It's this idea that dividends are pretty much just for folks who've already retired.
And there it is, the classic myth. Dividends are for seniors who are just trying to protect what they've got and maybe generate a little extra cash. It's kind of seen as the slow, boring, safe lane on the investing highway. But is that the whole picture?
Nope, not even close. The reality is, dividend investing is an awesome wealth-building tool for pretty much everyone. Now, what's really cool is how the strategy changes depending on your age. Yeah, for seniors, it might make sense to focus on those big, stable, blue-chip companies for reliable income. But if you're younger, the game's totally different. You can go after companies that pay smaller dividends now, but have huge potential to grow their business and that dividend payment over time. So the key takeaway here is this. It's a long-term strategy to build wealth, not just a way to cash out when you retire.
Okay, so this leads us right into the next big debate. It's the classic showdown, right? The high-flying, super exciting growth stocks versus their more steady dividend-paying cousins. Where are you actually gonna get the better returns?
This is a really common belief. The whole argument is that if you want pure, unadulterated returns, you gotta go with growth. The chance for a stock to double, triple, or more is just too tempting. And a lot of people think there's no way a little dividend can compete with that. But here's what that myth totally misses. Dividend stocks actually give you count 'em, three ways to grow your money. First, just like any stock, the share price can go up. Simple enough. Second, a healthy company can actually increase its dividend payments over time. And third, and this is where the real magic happens, you can reinvest those dividends to buy more shares, which then pay you more dividends. It's a powerful cycle, a real triple threat.
And this right here, this is probably the most important point of the whole discussion. You can't just look at the stock chart. You have to compare the total return. That means you've got to add the share price gains plus all those dividends you collected. When you look at it that way, you'll find that sometimes slow and steady doesn't just win the race, it laps the competition.
Okay, so let's flip the coin for a second. We've just talked about how dividend stocks aren't always the slowpokes people think they are. But there's another really dangerous myth on the other side of that coin, the idea that they're totally safe, risk-free investments.
The hard reality is, no investment is ever truly risk-free. I mean, you only have to look back at the 2009 financial crisis. You had entire sectors, like banking and real estate, sectors that were famous for paying reliable dividends. They just went into a complete nosedive. It's a really stark reminder of the oldest rule in the book. Don't put all your eggs in one basket. You absolutely have to diversify. It is essential.
So far, we've talked about all this from our perspective as investors. But let's switch gears for a minute. What about the company that's actually paying the dividend? Is sending all that cash out the door a sign of weakness? Or could it actually be a sign of incredible strength?
The argument from growth investors often goes like this. Every single dollar a company pays out as a dividend is a dollar it could have put back into the business to fund R&D, expansion, you name it.
And, on the surface, that makes a lot of sense. But that's assuming that the company would have spent that money wisely.
But here's the really interesting counter-argument. Having to pay a regular dividend can actually force the management team to be more disciplined. It makes them stay laser-focused on generating real, consistent cash. And when there's less spare cash just sitting around, there's a lot less temptation to go and blow it on some risky low-value acquisition or some pet project. It really does keep everyone honest.
So what about debt? You'd think a company should pay off all its debt before giving money to shareholders, right? Well, it's not that simple. If a company is just drowning in debt, then yeah, of course, survival comes first. But for a healthy company with a manageable amount of debt, continuing to pay that dividend sends this really powerful message of strength and stability out to the entire market.
All right, we've tackled the big picture ideas. Now let's get into the nitty-gritty and talk about some of the practical traps that can really trip up investors, even experienced ones.
This one is such a common trap. It's just so easy to pull up a stock screener and sort the list by the highest dividend yield, thinking, hey, bigger number, better investment. But that can be a massive mistake.
A really high yield is often a giant red flag. Just think about how yield is calculated. It's the dividend payment divided by the share price. So a crazy high yield might just mean the share price is tanking because the company is in deep, deep trouble. It could even be a warning sign that they're about to cut the dividend entirely. So the key takeaway is this: never, ever judge a stock by its yield alone. You have to dig into the fundamentals of the business.
And it's also good to know that companies have different philosophies here. Some just pay out whatever's left over after they've paid their bills, which is super unpredictable. Others aim for stability and pay a fixed amount every time. And then you have some that do a hybrid, a small fixed dividend with maybe a bonus if they have a great year. Knowing this just helps you understand that that dividend check isn't always a sure thing.
Okay, this next one is a myth that can cost you real money if you're not paying attention. A lot of us just assume that all dividends get that special, lower tax rate. But unfortunately, the tax man has other ideas.
The reality is, for your dividends to get that lower tax rate, they have to be qualified. And to qualify, you've got to meet a holding period rule. Basically, you have to own the stock for a little more than 2 months around a specific date. If you don't, well, those dividends get taxed at your normal income tax rate, which could be a lot higher. It's one of those small details that can have a huge impact on your bottom line.
Whew. All right, we have busted a lot of myths today. We've seen that dividend investing isn't just for retirees, and it's definitely not as simple as just picking the stock with the highest yield. The whole game is about finding a balanced, informed perspective.
So let's do a quick recap of what we've learned. First, dividends are for wealth builders of any age. Second, the number that truly matters is always total return. Third, a consistent dividend can be a sign of a really well-run company. Fourth, and this is a big one, a high yield can be a warning sign, not an invitation. And finally, the details, things like diversification and taxes, they are absolutely critical. So we've cleared away a lot of the confusion today. And the question I really want to leave you with is this one. Now that these myths are busted, how does this change the way you think about your own financial future? It's a really powerful question to sit with. Thanks so much for tuning in.
Dividend investing. It's the dream, right? That idea of generating passive income, of one day living entirely off your portfolio. But what if I told you that some of the most common paths to that dream are actually full of hidden traps? It is shockingly easy to build a portfolio that's set up to fail. Not because the stocks are bad, but because the strategy itself is broken.
So let's just get right into it. I want you to take a hard look at your own strategy. Is it a fortress, built to create lasting wealth? Or is it more like a house of cards, ready to get blown over by the next market downturn? The difference often comes down to just avoiding the simple mistakes we're about to cover.
You know, that beautiful dream of passive income can turn into a real nightmare if you fall into just a few of these common traps. So in this explainer, we're going to break down the biggest, most costly mistakes investors make so you can sidestep them and build a strategy that actually works. Let's dive in.
Okay, first up, let's talk about the mistakes that trip people up before they even invest a single dime. These are the errors in due diligence, and they're the foundation for either a really strong portfolio or, well, a really weak one.
The biggest mistake of all, really, the one that almost every other error stems from, is just skipping your homework. I mean, when you don't do the research, what are you left with? Just your emotions. And that means you're guided by greed when things are going up and by fear when they're going down. And that is a recipe for disaster.
And what I love about this slide is how it breaks down the two mindsets, right? You've got the investor on the left, driven by their heart, all fear and greed. And then you have the investor on the right, driven by their head, by knowledge. When you truly know what you own, and more importantly, why you own it, a market sell-off doesn't feel like a crisis. It feels like a sale. You start looking for bargains instead of running for the exit.
And you know, that leads us right into the next big mistake, falling for the hot tip. Come on, we've all been there. A friend, your brother-in-law, some talking head on TV, they give you a tip that sounds like an absolute can't miss. And that temptation to just dive in without thinking is huge.
But here's the thing you have to burn into your brain. A tip is not an investment plan. It's the starting pistol for your research, not the finish line. Remember, the person who gave you that tip isn't the one who's going to lose money if it goes bad. You are. You can't outsource your own financial security.
Oh man, and here is another classic trap. Confusing a cheap stock with a good value. It's so easy to do, isn't it? Buying a stock for 50 cents a share just feels less risky than buying one for $100. It feels like it has so much more room to grow. But this slide just nails the difference between price and value. See, a cheap stock often has a low price for a very, very good reason, like maybe the company is circling the drain. A value stock, on the other hand, is a great company that's just temporarily on sale. Speculators buy cheap stocks. Investors buy value. All right, so let's say you've done your homework. The next place you can get into trouble is with your actual strategy. These are the kinds of mistakes that happen when you have all the right information, but you come to the wrong conclusion. Let's look at some of these flawed tactics. This might be the single most common trap for anyone new to dividend investing. We're all drawn to it, like a moth to a flame. Chasing that big, juicy high yield, it's almost an automatic reflex. But you have got to be careful. A sky-high yield can be a massive red flag. A lot of the time, that yield is high not because the company is being generous, but because the stock price has been absolutely crushed. The market is basically screaming at you that the dividend is in danger and might get cut. That's why, so often, a lower, steadily growing dividend is a much safer and ultimately more profitable choice.
Let me show you what I mean with a quick example. So, imagine you buy a solid company. It's a $10 stock, and it's paying a nice, respectable 2.5% yield. Nothing crazy, but it's solid. That's 25 cents per share every year.
Okay, now let's hit the fast forward button. Let's say it's a good company, and over 10 years, both its stock price and its dividend grow by a steady 10% each year. Your original $10 share is now worth more than $23. That's amazing growth. But that's only half the story. The real magic is what happened to your income.
And this is where it gets really exciting. Because the dividend payment itself has been growing, your income stream has grown right along with it. Based on that original $10 you invested, your annual return from that dividend isn't 2.5% anymore. It's now almost 6%. We call this yield on cost, and folks, it is the secret weapon of successful long-term dividend investors.
So the big takeaway here is really clear, right? Don't get blinded by a high starting yield. The real power, the true wealth-building engine, comes from a company that can consistently raise its payout over a long period of time.
Now, let's talk about another flawed strategy. This one's another one of those get-rich-quick schemes that, on the surface, seems like a brilliant little hack to make free money.
I mean, just look at the logic here. It seems so simple. You buy the stock right before the ex-dividend date, so you qualify for the payment. You collect the cash, then you sell the stock right after. Free money, right? Wrong. The market is way smarter than that. On that ex-dividend date, the share price is automatically reduced by the exact amount of the dividend. So you get the dividend, sure, but you lose the same amount in the stock price. You basically just break even, minus your trading costs.
Okay, here's a mistake that doesn't feel like a mistake until it's way too late. Completely ignoring taxes. You can have the best investment strategy on the planet, but if you're giving a giant chunk of your returns back to the government, you're running a race with one leg tied behind your back, because it's not what you make, it's what you keep. And this chart just makes it painfully obvious. Look at that difference. On a $200,000 gain, a higher tax rate could cost you an extra 40 grand. That's a new car. That's a year of college tuition. This is why understanding things like qualified dividends and using tax-advantaged accounts like an IRA or a 401k isn't just a minor optimization. It's a critical part of your overall strategy.
Finally, let's get into the mistakes that happen after you've already bought the stock. See, owning it is just the beginning. How you manage your portfolio day in and day out is every bit as important as how you built it in the first place.
And this one is all about emotion. It is incredibly hard for us to admit we made a mistake and sell a stock for a loss. We get attached. We tell ourselves that little lie, I'll just wait until it gets back to even. But that is a losing game. Hope is not an investment strategy.
I absolutely love this analogy from the source material. It's just so simple and so true. If the reasons you bought a stock in the first place have fundamentally changed for the worse, you have to be disciplined. You cut your losses, take that money, and put it to work somewhere better. You have to move on to a new fishing spot.
So how do you know when it's time to get out? Well, this table gives you some excellent unemotional guidelines. If a company gets rid of its dividend completely or cuts it because the business itself is failing, the writing is on the wall. You sell immediately. Other situations, like a cut because the whole economy is bad, that takes a little more judgment. The key is to have a plan like this before your emotions can take over.
So, we've covered a lot of ground. Mistakes in your research, your strategy, your management, but it all really boils down to one simple, unifying principle. Kind of a golden rule that separates the really successful long-term investors from everybody else.
And this is it. This quote says absolutely everything. The winners aren't the ones chasing hot stocks or panicking during a crash. They are the people who put in the work, who know what they own, and who have the discipline to stay calm when everyone else is freaking out.
So I'm going to leave you with this one last question. Take an honest, hard look at your own portfolio. Which of these traps might be hiding in there right now in plain sight? Because finding them, that's the first and the most powerful step you can take toward building a dividend strategy that's actually going to work for you for the long haul.